As of this very moment, Opendoor Technologies, trading under the ticker symbol OPEN, is hovering right around the $7.68 mark, showing a slight intraday contraction of roughly 0.7%, though the stock remains incredibly active, with volume already pushing past 17 million shares in the morning session alone. If you are watching the charts on your Fidelity mobile app or tracking the ticks on an interactive broker's trading screen, you might see this price point and assume it is just another day of standard volatility for a mid-cap tech stock. But that assumption would be a massive oversight of what is actually happening beneath the hood of this company. The expectation for Opendoor has long been that it is a distressed asset, a leftover relic of the pandemic housing boom that is slowly bleeding out as interest rates remain stubborn. But the reality you are looking at today is entirely different. You are witnessing one of the most aggressive, complex, and high-stakes financial engineering pivots of 2025. This is no longer just a company flipping houses. It is a company that has effectively turned its own equity into a derivative structure through a massive warrant dividend, forcing the entire market to reevaluate how they price risk in the real estate sector. The narrative that most retail investors have swallowed is that Opendoor is simply at the mercy of the Federal Reserve, that if Jerome Powell cuts rates, Opendoor survives, and if he doesn't, it dies. But the price action we have seen over the last few weeks, rallying from deep penny stock territory of 60 cents to nearly $8, suggests that the market is pricing in something far more idiosyncratic than just a macro bet. When you look at the recent warrant dividend issuance, Series K, Series A, and Series Z warrants distributed to shareholders, you are seeing a maneuver that is rarely executed by companies in this position. This isn't just about raising capital. It is about creating a complex incentive structure that forces short sellers, who have been piling into this name on platforms like SoFi Invest and Robinhood, to reconsider their exposure. If you are short a stock, and that stock issues warrants as a dividend, you are often on the hook for delivering those warrants, which can create a scramble for liquidity that has nothing to do with the fundamental business of selling homes, and everything to do with the mechanics of market structure. This is the kind of nuance that separates the casual observer using Schwab Intelligent Portfolios from the active trader digging through SEC filings. What is driving this stock right now is a violent collision between a technical short squeeze and a fundamental business pivot. The volume we are seeing today isn't just mom and pop buying a few shares for their Fidelity IRAs, it is algorithmic capitulation and accumulation. When we look at the institutional data, we see massive players like Jane Street and Renaissance Technologies increasing their stakes significantly. Jane Street alone increased its position by over 1,000% in recent filings. These are not value investors looking for a safe dividend yield. These are quantitative firms that smell volatility and inefficiency. They are betting on the mathematical probability of a mean reversion or a squeeze, and their presence suggests that Opendoor has become a battleground for high-frequency trading strategies. This makes the stock behave less like a traditional real estate company and more like Tesla stock or Nvidia stock during their most volatile expansion phases, where the price action is driven by option flows and gamma exposure rather than just how many houses were sold in Phoenix last quarter. However, we have to ground this excitement in the cold, hard numbers of the business itself, because if you strip away the financial engineering of the warrants and the hype around the new CEO's 10x vision, the fundamentals present a much starker picture. The company recently reported third-quarter revenue of $915 million, which actually missed analyst expectations. They posted a net loss of $90 million. If you are analyzing this strictly from a value investing perspective, perhaps looking at it for your Fidelity Wealth Management long-term plan, these numbers would be terrifying. Revenue is down, losses are widening, and the gross margins are still razor-thin. The expectation is that the housing market is thawing, but the reality you are looking at today is that they are selling fewer homes and struggling to clear inventory at profitable spreads. The disconnect between a stock that has rallied hundreds of percent from its lows and a business that is shrinking its top line is the tension that defines this trade. You are not buying a healthy business today. You are buying a call option on a turnaround that is being orchestrated by a management team that has decided to burn the boats and reinvent the company as a software and AI play. This pivot to AI and software is the critical new variable. The new CEO, Kaz Nejatian, has explicitly stated that the goal is to refound Opendoor, not as a capital-intensive asset manager, but as a technology platform. The idea is to automate the entire home transaction process: inspection, pricing, closing, using AI to reduce the human cost and the time friction. If you think about the traditional investment in real estate, it's slow, clunky, and filled with paperwork. Opendoor wants to be the Robinhood app of home selling: instant, digital, and frictionless. But saying you are an AI company and actually monetizing it are two different things. The market is currently giving them the benefit of the doubt, assigning a valuation premium to this tech story that they wouldn't give to a simple house flipper. This is why we see the stock holding these higher levels despite the revenue miss. Investors are looking past 2025 and betting on 2026 and 2027, wagering that the data advantage Opendoor has built over the last decade is a moat that no traditional brokerage can cross. Let's pause on the market mechanics for a moment, because the intraday action we are seeing right now is heavily influenced by the broader sector rotation. We are seeing money move out of safe, defensive consumer staples and into higher beta risk assets. Opendoor is arguably one of the highest beta stocks you can find. It acts as a leveraged bet on the 10-year Treasury yield. When yields dip even slightly, Opendoor rips higher because lower rates mean cheaper mortgages, which means more transaction volume. If you are managing your own self-investing strategy, you need to understand that holding open is functionally similar to holding a short position on interest rates. You are exposed to the macro environment in a way that is almost binary. If the Federal Reserve signals a pause or a cut, this stock can move 20% in a week. If inflation data comes in hot, it can give those gains just as fast. This sensitivity is why it attracts the Robinhood stock trading crowd, because it offers the kind of adrenaline and rapid returns that you simply cannot get from a diversified ETF or a standard Fidelity mutual funds allocation. I want to hear from you guys on this point, because the sentiment around this stock is so polarized. Comment below how many shares of Opendoor you currently hold, and more importantly, are you holding on to those new warrants, or did you sell them immediately? The strategy with the warrants is complex, and I'm curious to see how the retail side is handling that distribution compared to the institutions. Returning to the analysis, we need to talk about the inventory risk. Unlike Apple stock, where inventory is just iPhones sitting in a warehouse, Opendoor's inventory is houses that require maintenance, taxes, and insurance. Every day a home sits on their balance sheet, it burns cash. The company has made aggressive moves to reduce this inventory, slashing their holdings to preserve capital. This is a double-edged sword. On one hand, it reduces risk. On the other hand, you cannot generate revenue if you have nothing to sell. The massive drop in revenue we saw in Q3 is a direct result of this shrink-to-survive strategy. They are intentionally doing less business to avoid doing bad business. This is a sign of discipline, which is good, but it also means the growth story is currently on pause until they feel confident enough to start ramping up acquisitions again. For those of you using investing sites to screen for growth, Opendoor currently looks like a shrinking company, but a smart analyst knows that this shrinkage is strategic, not accidental. We also have to consider the competitive landscape. You have Zillow, which famously exited the iBuying business because they couldn't make the math work. And you have Redfin, which also pulled back. Opendoor is the last major gladiator standing in the arena. This gives them a potential monopoly on the instant offer model if they can survive. But it also raises the question, if everyone else left the room, maybe the room is on fire. The contrarian take, the one that justifies the current $7 tag, is that because competitors fled, Opendoor now has the pricing power to demand wider spreads. They don't have to outbid Zillow anymore. They can offer a seller a price that is slightly lower, securing a better margin for themselves because the seller has no other instant option. This lack of competition could be the key to their long-term profitability, assuming they can keep their overhead costs low enough. The role of the retail investor here cannot be overstated. Stocks like Opendoor live and die by sentiment. We have seen this with SoFi stocks and other fintech names that have a cult-like following. The community of shareholders often acts as a floor for the price point, refusing to sell even when the news is bad. This creates a disconnect between fundamental value and market price. If you are looking at Interactive Brokers trading data, you might see high short